our radar. But the other company on our radar is UFlex. Weak set of numbers coming in, in the quarter, though there was some sequential improvement. Year on year, the EBITDA saw a decline. The company's revenues were down 12.5%. We had a decline of 40% in their EBITDA, and the net profit was all but eroded. We have Rajesh Bhatia, who's the Group President and Finance and Accounts, joining in. Thanks a lot, Mr. Bhatia, for joining in. The fourth quarter was very weak. So was FY23. Just wanted your thoughts on this quarter now and the remainder of this year. How much did you see in terms of recovery for the BOPET and BOPP spreads? What's the outlook for this?
I think we have to split this into two. First is, regain the volumes back in the market. And happy to state that for the quarter on a sequential quarter basis, we've done close to about 6.5% volume growth in the packaging films business. In the flexible packaging business, that growth is about 21%. So both the volumes are coming back, and we've seen also the strong growth from the FMCG segment. So the flexible packaging business continues to do extremely well, and the packaging films business is also regaining its volumes. The margins in the European territory still remains, below our expectations. In the Americas, they have improved both the volumes as well as the margins. So overall, as you said, that on a sequential basis, we have about a 34% increase in EBITDA this year. And I think we believe that the worst is over. And one more quarter and Q4, we'll see the better margins coming. Already we are from a last quarter of about 9.3% EBITDA margin. We are at about 12% EBITDA margin now. So, and that's what I had said, that, the first target is to go to about 12% EBITDA margin and maintain that over a reasonable period, and then see the volume and the margin growth from there on.
Okay.
So Q4, what we are guiding that, that should be better than the Q2 as well as the Q3.
Okay, so Q4 is when you actually expect things to pick up, should be better than Q2 and Q3. But what would your exit margins be for the year then, sir? You've improved to 12%. You're expecting business to improve by Q4 considerably. Exit margins?
I think the quarter was about 12. So Q3, we will be between 12, 12.5. And Q4, if we can take about 13.5 or so, I think that would be a reasonable achievement.
All right. So Q4, your margin should probably hit 13.5%. That's important to note. You did mention your volume growth in both of your segments. I think it was 21% in your flexible packaging segment and 6.5% in the films business, if I'm not mistaken, and correct me if I'm wrong. So
on sequential basis.
What can be extrapolated to, considering that you're expecting this pickup in Q4, again, what is the second half volume guidance? What can we hit in Q4? And what can you sustain in FY25?
I think what we can achieve in Q3 and Q4 is about 7 to 8% growth in the packaging films business. And the flexible packaging business will, I think, more or less remain at around these levels only, while we've seen very good numbers coming from the FMCG companies, which means that, they'll give a lot of incentives for the increase in their volumes. But I think that remains to be seen. The packaging films business is where the focus is to, increase the utilization, increase the volumes, and that's what. So for the next 2 quarters, if we can achieve about 8% sequential growth, I think that would be our target.
What about you setting up a PET chip resin facility in both India and Egypt? Can you tell us what the capacity of this will be? By when does it get commissioned? What's the capex outlay, and as a result of which, how much it helps your margins because it's backward integration?
India business, we are on track to complete it by end of this financial year, probably end of this or early part of the April. The capacity is about 140,000 tons over there. We make both the PET chips for our packaging film business as well as a small capacity to cater to the requirements also of the PET bottles business as well. And we've spent about 590 crores capex on this project, and we'll complete it. Hopefully, we'll complete this within this financial year or maximum by April of 24. Egypt one will take a bit of a time, so that will get commissioned about a year later after we commission the India plant.
So how much does that save in terms of margins for you?
I think based on the present prices, we should aim to get about 1.5% extra margins for our packaging films business.
Okay. You had mentioned, sir, that you're facing some amount of pressure in Europe. Can you just tell us what the outlook is for your export business going into the second half, FY25, simply because, there's an expectation that rates will now start impacting growth in these markets, plus we have the overhang of geopolitics. So within that context, what is your guidance in terms of your export business?
So I think exports, if you say European markets, that we cater from our European and the Middle Eastern plants only. Our plant in Egypt, so we have plant in Poland, we plant in Hungary, and we plant in Egypt. The Egypt plant also partially serves the European market, so that's the market we serve locally itself. So the demand is down here because of the obvious reasons which we've been saying that. Because of the higher energy costs, higher EMI costs, higher inflation rates. So the overall consumer demand is low, which is leading to the lower demand for the flexible packaging itself. I think what I said that America this quarter, we have seen a much better demand as compared to the Q1. And while Europe was almost flat, a little bit higher than the Q1, but largely I would say it is flat. So that still remains our focus point. America has definitely improved, and as we've seen now this quarter, the inflation in US is now down to 3.2%, lower than what the market has expected. So with the foresight now that the interest rates in US will come down, so I think that should improve the demand for the consumer goods.
All right, so then let's quickly wrap this up, Mr. Bhatia, with a guidance on your revenues, margins, and volume for the remainder of this year, for the full year. And how do you expect, your books to look when we look at the end of FY24 in terms of revenue and volumes with margins?
I think the revenues on a year-to-year basis, we should look at about 10% down from the last year on an overall basis. On the EBITDA side, I think if we are happy that if for the year as a whole we can do about 11 to 11.5 range for the year as a whole basis, given that the first quarter was only 9.3% and the second quarter is 12%. So overall, if we can achieve about 11.5. I think that's the target right now.
All right, take that point. Thanks a lot, Mr. Bhatia, for joining in. Wish you good luck for the remainder of this year, and also season's greetings to you and your team. With that, take a short break. But on the other side, we shift focus away from the equity markets. And no, we're not going to talk about commodity markets. We're going to talk about Team India. It'll be looking for a payback for the disappointment that we saw in 2019. They face New Zealand again in the semi-finals of a Cricket World Cup. Today happens in a couple of hours from now. So what are the experts weighing in? There is a fair amount of excitement. Let's get chatting with experts on the other side.